Journal voucher. This is the source of input to the general ledger which can be used to represent summaries of single transactions or a single unique transaction, identifies the financial amounts, and affected general ledger accounts. The GLS database. The GLS database includes a variety of files, whereas these will vary from firm to firm. The following examples are representative. General Ledger Master File. This is the principal file in the GLS database. This file is based on the organization's published chart of accounts. Each record in the GL Master is either a separate GL account, for example sales, or the control account such as AR control, for a corresponding subsidiary ledger in the transaction processing system. Figure 8-3 illustrates the structure of a typical GL Master file. The FRS draws upon the GL Master to produce the firm's financial statements. The General Ledger History file has the same format as the GL Master. Its primary purpose is to provide historical financial data for comparative financial reports. The Journal Voucher file is the total collection of the journal vouchers processed in the current period. This file provides a record of all General Ledger transactions and replaces the traditional General Journal. Journal Voucher History file contains journal vouchers for past periods. This historical information supports management's stewardship responsibility to account for resource utilization. Both the current and historical journal voucher files are important links in the firm's audit trail. The Responsibility Center file contains the revenues, expenditures, and other resource utilization data for each responsibility center in the organization. The MRS draws upon this data for input in the preparation of responsibility reports for management. The Budget Master file contains budgeted amounts for revenues, expenditure, and other resources for responsibility centers. These data, in conjunction with the Responsibility Center file, are the basis for responsibility accounting. The Financial Reporting System. Much of the information provided takes the form of standard financial statements, tax returns, and documents required by the regulatory agencies such as the Securities and Exchange Commission. The primary recipient of financial statement information are external users such as stockholders, creditors, and government agencies. Financial reporting procedures. 1. Capture the transaction. 2. Record in special journal. 3. Post to subsidiary ledger. 4. Post to general ledger. 5. Prepare the unadjusted trial balance. 6. Make adjusting entries. 7. Journalize and post adjusting entries. 8. Prepare the adjusted trial balance. 9. Prepare the financial statements. 10. Journalize and post the closing entries. 11. Prepare the post-closing trial balance. Extensible Business Reporting Language, or XBRL, is the Internet standard specifically designed for business reporting and information exchange. The objective of XBRL is to facilitate the publication, exchange, and processing of financial and business information. XML. XML is a meta-language for describing markup languages. The term extensible means that any markup language can be created using XML. This includes the creation of markup languages capable of storing data in relational form in which tags or formatting commands are mapped to data values. Thus, XML can be used to model the data structure of an organization's internal database. XBRL. XBRL is an XML-based language that was designed to provide the financial community with a standardized method for preparing, publishing, and automatically exchanging financial information, including financial statements of publicly held companies. XBRL is typically used for reporting aggregated financial data, but also applied to communicating information pertaining to individual transactions. Internal control implications of XBRL. Potential benefits of XBRL and associated web technologies have been extensively researched. However, here are 3 areas of specific concern, which are: Number 1. Taxonomy creation. Number 2. Taxonomy mapping error. And 3. Validation of instance documents. The Management Reporting System. Management reporting is often called discretionary reporting because it is not mandated, as is financial reporting. One could take issue with the term discretionary and argue that an effective management reporting system is mandated by SOX legislation, which requires that all public companies monitor and report on the effectiveness of internal controls over financial reporting. Factors that influence the MRS. This section examines several topics that provide insight into the factors that influence management information needs. These are management principles, management function, level and decision type, types of management reports, responsibility accounting, and behavioral considerations. 1. Management principles. Management principles provide insight into management information needs. The principles that directly influence the MRS are formalization of tasks, responsibility and authority, span of control, and management by exception. 2. Management function, level, and decision type. The management function of planning and control have a profound effect on the MRS. The planning function is concerned with making decisions about the future activities of the organization. Planning can be long-range or short-range. Long-range planning usually encompasses a period between 1 and 5 years, but this varies among industries. Short-term planning involves the implementation of specific plans that are needed to achieve the objectives of the long-range plan. The control function ensures that the activities of the firm conform to the plan. This entails evaluating the operational process or individual against a predetermined standard, and when necessary, taking corrective action. Types of management reports. A management report may be a paper document, oral, digital, or image displayed on a computer terminal. The report may express information in verbal, numeric, or graphical form, or any combination of these. Reports must have information content. Their value is the effect they have on users. This is expressed in two general reporting objectives. 1. To reduce the level of uncertainty associated with a problem facing the decision maker, and 2. To influence the decision maker's behavior in a positive way. Report attributes. To be effective, a report must possess the following attributes: relevance, summarization, exception orientation, accuracy, completeness, timeliness, and conciseness. 4. Responsibility accounting. This concept implies that every economic event that affects the organization is the responsibility of and can be traced to an individual manager. A fundamental principle of this concept is that responsibility area managers are accountable only for items, costs, revenues, and investment that they control. Cost centers. A cost center is an organizational unit with responsibility for cost management within budgetary limits. For example, a production department may be responsible for meeting its production obligations while keeping production costs within the budgeted amount. Profit centers. A profit center manager has responsibility for both cost control and revenue generation. This includes decisions about which items of merchandise to stock in the store, what prices to charge, the kind of promotional activities for product, the level of advertising, the size of the staff and the hiring of employees, and the building maintenance and limited capital improvements. Investment centers. The manager of an investment center has the general authority to make decisions that profoundly affect the organization. Assume that a division of a corporation is an investment center with the objective of maximizing the return on investment asset. The division's manager's range of responsibilities includes cost management, product development, marketing, distribution, and capital disposition through investment of funds in projects and ventures that earn a desired rate of return. 5. Behavioral considerations. A carefully structured MRS plays an important role in promoting and preserving goal congruence. On the other hand, a badly designed MRS can cause dysfunctional actions that are in opposition to the organization's objective. Two pitfalls can cause management to act dysfunctionally are information overload and inappropriate performance measures. Information overload. Information overload occurs when a manager receives more information that he or she can assimilate. This happens when designers of the reporting system do not properly consider the manager's organizational level and span of control. Inappropriate measures. One purpose of a report is to stimulate behavior consistent with the objectives of the firm. When inappropriate measures are used, however, the report can have opposite effect on investment, employee training, inventory reserve levels, customer satisfaction, and labor relations. Performance measures should consider all relevant aspects of a manager's responsibility.